You see a bigger version of that move this time around. We've already had a pretty nice move, 1,800 or so announced to 26 and change announced right now. But it could go much further than that based on history. So if we have a move that is commensurate in percentage terms, then you got $5,000 or $6,000 an ounce gold and $200 or so an ounce silver, and that's totally possible given history and given the amount of debt that's out there.
John Rubino, co-author of The Collapse of the Dollar and founder of dollarcollapse.com, believes that gold and silver are poised for significant gains in the current economic environment. He notes that gold has already climbed from approximately $1,800 to $2,600 per ounce, and based on historical trends, it could reach $5,000 to $6,000. Similarly, silver might surge to $200 per ounce if inflationary pressures and capital flows intensify. Recently, gold prices hit a record high during the North American session on Thursday, reaching $2,691, up by over 0.66%. Despite this surge, the precious metal fell short of breaking the $2,700 mark amid the uncertainty of the U.S. elections. Economic data, including strong retail sales and jobs reports, underscored the resilience of the U.S. economy but did not significantly weigh on gold prices. Beyond U.S. developments, central bank policies worldwide are shaping the outlook for precious metals, particularly silver. The European Central Bank is expected to reduce its main refinancing rate by 25 basis points, while the Bank of England and the Reserve Bank of New Zealand are signaling potential rate cuts. These dovish policies reflect global efforts to ease economic pressures, which could further drive demand for safe haven assets like silver. Although geopolitical tensions in the Middle East add to the demand for safe haven assets, the market's primary focus is economic factors. Silver prices will likely remain elevated if central banks continue their accommodative policies and bond yields stay low. This environment offers protection against market uncertainty, making precious metals increasingly attractive to investors. Rubino highlights that if inflation rises from 3% to 4%, many investors will likely shift their capital away from government bonds, recalling the losses incurred in 2022. While not all capital will flow into gold and silver, these assets are expected to be the primary beneficiaries of this trend. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
In 2022, a long-term government bond portfolio yielded maybe 4%, and the dollar lost, let's say, 9% officially of its value. So that means that the bond portfolio lost 5% in real terms. And the bond markets remember that, because that's catastrophic for a government bond portfolio. That's supposed to be the thing that grows risk-free at 3 or 4 or 5% a year. So the bond market remembers. So when inflation picks back up again, if it goes from 3% to 4%, let's say, in any given year, the bond market will react based on their memory of being burned so badly in 2022. So yeah, they'll start swapping out of treasuries and into, it won't be just gold and silver, but gold and silver will be one of the beneficiaries of that capital flow. The higher inflation goes from that 3 or 4% range, the more money will flow out of fixed income and into real things. So that's kind of an inevitable thing with all the financial mistakes we've made in the last 20 or 30 years and all the excess debt we've taken on. And it's good for gold and silver. If you look at the previous 2 times this happened, one was in the 1970s, as you said, and the other was during the Great Recession, when governments were just cutting interest rates like crazy and bailing everybody in sight out. That spooked people who owned government bonds, and a lot of money poured into gold and silver. So you saw gold go from $200 an ounce and change in 2000 to $1,900 an ounce. Did I say 200 or 2000 to begin with? It was 200.
You said 200. Yeah, okay. It was like 250 or whatever, yeah, somewhere around there.
Yeah, and it went to 1900-ish. An ounce at the end of the cycle because of so much money pouring out of fixed income and into precious metals. Now the numbers are way bigger and the financial risk is much greater. So it's possible that you see a bigger version of that move this time around. We've already had a pretty nice move, 1,800 or so an ounce to 26 and change an ounce right now, but it could go much further than that based on history. So if we have a move that is commensurate in percentage terms, then you got $5,000 or $6,000 an ounce gold and $200 or so an ounce silver, and that's totally possible given history and given the amount of debt that's out there.
JohnRubino highlights silver's strong growth potential, driven by increasing industrial demand from the solar and defense sectors, and its role as a monetary metal, which tends to rise alongside gold during periods of financial instability. Silver prices have extended their gains for 3 consecutive days, remaining just below the $32 mark as rising U.S. Treasury yields limit further advances. Despite this, silver continues to climb, supported by resilient demand. The silver dollars currently trades at $31.90, up 0.80% from its opening price, consolidating in the $31.50 to $31.90 range. Silver experienced a sharp drop from its year-to-date high of $32.95 to $30.12 within just 3 days, but the metal is now in recovery mode. Buyers are eyeing a potential test of the $33 level as silver continues to regain momentum in the face of macroeconomic pressures. Let's get back to the interview.
The silver story is shockingly positive, and that's because it's actually two stories. Silver is an industrial commodity that is used by solar panel makers and by the defense industry and by the rest of the electronics industry. And especially the solar part of the story is rising dramatically. And the defense guys won't tell us how much silver they use, but there are analysts out there who think it's bigger than the solar demand. It's also a monetary metal that tends to rise when gold rises. So if the same factors that make gold go up make silver go up, and it's had some dramatic rises in the past. So you take those two things together, either one of which would make it kind of an attractive investment. You put them together, and you get a metal that's in deficit right now. The world's mines are not producing enough silver to soak up all the demand for it, or to satisfy all the demand for it. And that deficit is in danger of turning into a shortage where, some people who really need silver just can't get it. And panic buying ensues. And silver is such a tiny, thin little market that if for instance, the COMEX, where futures contracts on silver are traded and people can take delivery if they want to. And let's say people start demanding more silver than the COMEX has, and the COMEX has to default. And all these people out there know they're going to need silver in the next few years for their industry, or because they don't have enough stacked yet, and as investors, they need more. Then people are really going to just pay whatever it takes, and you'll see silver go straight up. That's a scenario that is actually not that far-fetched from silver, because each piece of it is completely legit. I mean, solar is a real demand. The military hardware is a real demand. Electronics, that's real. And investors who see gold at $2,600 an ounce and calculate that they can buy 70 ounces of silver for that one Krugerrand cost, they start buying silver really aggressively. All that stuff is kind of, it's not secret. It's not a far-fetched scenario. It's all just stuff that's happening out there in the world. Put it all together, though, and you get a really nice scenario for silver. And then the other thing is that mining just became it was already a really hard business, but it got harder in the last few years. And partially that's because of inflation. Energy prices were up, which means the energy cost of mining is higher than it used to be, and wages are way up. The mining industry can't find enough good people. So they're having to pay way up for the good ones that they can find. And so their wage costs are up. And then a lot of governments out there are changing their policies vis-a-vis the mining industry in unfavorable ways. For instance, Panama just closed one of the world's biggest copper mines. And Mexico has been talking about banning open pit silver mining, although they haven't done it yet. There's no guarantee that they do it, but they're talking about it. And you can't discount it now in this world because governments are doing so many other things. That makes it harder to look at a gold mine and extrapolate from the gold price to the money that the gold mine is going to make going forward. And so gold miners haven't caught the kind of bid that they would normally with gold going up as much as it has. But that day will come. I mean, there's a number out there on the gold price that will light a fire under the gold miners, because even with their higher costs, if gold is high enough, that gives them a massive increase in revenues. And for the best miners, a lot of that revenue bump will make it all the way down to net earnings and free cash flow.
As economic uncertainty persists and central banks maintain accommodative policies, gold and silver remain valuable assets. With silver's industrial demand rising and both metals benefiting from financial instability, investors are increasingly eyeing them for protection. As inflationary pressures mount, precious metals are poised for further gains, making them attractive for those seeking a hedge against market volatility. What are your thoughts on the future of precious metals amid the current economic challenges? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.